Good afternoon, ladies and gentlemen. Welcome to the JADE Investments Limited 2021 Interim Results Investor Presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged, can be submitted anytime by the Q&A tab situated on the right-hand corner of your screen. Simply click Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and will publish responses where appropriate to do so. These will be available via your Investor Meet Company dashboard and you'll be notified once they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to SURESH WITHANA, Investment Manager of JADE Investments Limited. Good afternoon, SURESH.
Good afternoon, and good afternoon to all of those who have joined our presentation. Thank you for taking the time to listen to this. JADE recently announced its interim results, which I will walk you through at a high level. The detailed results are available on our website, and there are details of that at the end of this presentation, I believe. Just by way of quick summary, we'll be going through the initial part of this deck that I'm presenting on, but a fuller version of this deck is actually, again, available on our website, which people are free to access. Just a couple of words about myself for those of you listening that have never met me or have never heard me speak before. I'm the managing partner of Harmony Capital Partners, which is the external investment manager of JADE Investments. I founded the firm almost 16 years ago now, and most recently we took over management of JADE Investments back in May 2017 and have worked since that time to reposition the portfolio, to reposition the company for the opportunity that is presented to us in Asia, which again I will talk a little bit more about as we go through the presentation. My experience is there, it's on our website, so I won't talk about that, but I've been on the buy side now for several years, particularly the last 13 years of my career in particular have been focused on investing in Asia. We have a large team based across Asia, in Hong Kong, in Singapore, as well as in our offices in London. So we have a footprint that spans from Europe all the way into Asia, but most of our investment team is based in Asia, and they are responsible for the management of the portfolio of JADE Investments. In terms of us as a company, we've taken over, as I said, in May 2017, the management of JADE. The net asset value per share has been relatively stable. There's been a decline more recently in the net asset value per share since we took over management because JADE issued shares in its first ever capital raising or placement, excuse me, back in 2020. In terms of gross portfolio income, which has been a stated objective of the company and of the board, which is to drive income from its portfolio of investments. It was negligible before Harmony Capital took over running this portfolio. And as you can see from our results, our portfolio income has increased rather substantially starting back in 2019. So that's a little bit about Harmony Capital and performance of JADE at a very high level since we took over as the manager. But more specifically, who we are and what we do, that is JADE Investments. We are a London-listed investment company that focuses on the SME space, particularly in the small and medium enterprise sector in Asia. Our strategy really is to provide growth capital and financing to small and medium-sized enterprises across the region. We have a very rigorous due diligence and process and a very disciplined risk management process internally, which helps us proactively manage our portfolio. So we're not a passive investor. So by that I mean that JADE never makes investments and then hopes that things work out, but we take a very active role in our investments, oftentimes asking for board seats, governance, oversight, etc. We have a track record through Harmony Capital of essentially generating returns over and across market cycles. As I said, Harmony Capital in particular has been around for now almost 16 years. The governance of JADE itself is entirely independent. So for example, even though I'm the investment manager and Harmony Capital is the external investment manager as a firm, none of us sit on the board of JADE. The board of JADE is entirely independent. I will walk you through the profile of the board a little bit towards the end of our presentation, but it's comprised of people with exceptional expertise, both in Asia, in areas of risk management, governance, with public company experience. And this board of JADE acts as the investment committee of the vehicle. So there's a complete independence ultimately in terms of decision making when it comes to investments, versus we as the investment manager who make recommendations obviously and help the board understand the investment decisions that they are being asked to deliberate on. We have obviously established expertise. As I mentioned in my introduction, we've been in Asia for several years. Jade Road itself is entirely dedicated to Asia. Our footprint is entirely Asian in terms of having investment professionals on the ground. So we don't manage from afar, we manage in the trenches and on the ground in Asia. And that somewhat distinguishes us from many other vehicles that may look at Asia as an investment destination. We also have a fairly large shareholder on our register, which anyone can see from our disclosures. They've been very supportive since 2014. Behind the shareholder ultimately sits a sovereign wealth fund from the Gulf region. They haven't disclosed their name publicly, but that investor and the fund itself that owns a large stake in Jade Road has been very supportive of our activities over the last several years. Turning to the interim results, which again are available on our website in some detail, but speaking specifically for the first half of 2021, our total income increased to $1.25 million for the half year, which was predominantly driven from interest payments as well as some fair value adjustments. That compares to about 1.19 million in the same period of 2020. Our net loss narrowed, as can be seen there, narrowed to about $270,000. And what was also particularly encouraging was our consolidated loss per share also narrowed somewhat to about 24 US cents per share, compared to about 69 cents in the same period in 2020. Our consolidated net asset value of the vehicle, of Jade Road itself, was relatively stable, around 106 million US dollars, or 76.8 or 77 million pounds. And as I said earlier, our net asset value per share has declined slightly because of the issuance of shares in the second half of 2020 for a private placement or a capital raising, which Jade Road undertook for the very first time in its history. We've also disclosed that our period ending cash position was about $2.5 million US dollars. For those that are new to Jade Road, you may be wondering why I'm talking in US dollars and pounds. Obviously, we're quoted in pound sterling. We're traded in pound sterling because we're listed on the London Stock Exchange. That being said, the currency of investment in Asia is typically US dollars. So our portfolio typically tends to be valued in US dollars. Our investments tend to be made in US dollars. And that's the reason why we rely so heavily on US dollar denominated reporting, even though our traded stock is denominated in pounds. Just some quick results, quick highlights of the portfolio. I'd say overall, we were very happy with the stability in our portfolio in Asia. As many of you or all of you would know, Asia has faced its challenges in the first half of 2021, and those are ongoing as we speak today, particularly in relation to this never-ending pandemic we all seem to be suffering under. But particularly in Asia, there's been some challenges about the speed of the recovery. And given that backdrop, we've been very encouraged by the way our portfolio has performed. Our largest investment, which is Future Metal Holdings, which is a large magnesium dolomite quarry in northeastern China, has performed well. We've seen an upward trend in sales in the first half of 2021. It's a private company, so we're not in a position to disclose its actual financial results, but we can talk sort of more broadly about the sector in which it operates, how the company is performing. And as I said, the company is performing relatively well, which is encouraging for us because we are aware of the fact that the Chinese economy at the ground level is starting to resuscitate, and that's certainly being driven by a number of government policies to help China recover as an economy from the effects of the pandemic, particularly in 2020. We have a Michelin-starred business, Michelin-starred restaurant and food and beverage business in Hong Kong for Clan Moon. Again, that was severely impacted as a business originally going back to 2019 due to some social unrest in Hong Kong. And then obviously the pandemic restricted the number of tourism as well as inbound tourism, particularly from mainland China. As these restrictions have started to be lifted in Hong Kong, we're starting to see a return to business. We're starting to see not quite normality, but at least a pathway to normality. So again, that business has been performing relatively well. in the first half of 2021. One of our investments, which is a very exciting digital healthcare business that operates all across Southeast Asia, called DocDoc, has been, again, performing very well. There's been a renewed focus, obviously, on healthcare solutions, how to get healthcare solutions to the ultimate beneficiary, being the patients. And DocDoc is a platform built for that well before the pandemic, which is to empower patients in making informed decisions about how they are treated for whatever ailments that they may be that they may require treatment for. And so there's been a lot of interest in DocDoc. There's been a lot of discussion around DocDoc. Again, it's a private company. I used to sit on the board of DocDoc. I'm no longer on the board, but that being said, we're very close to the company. We understand what they're doing, and we think that the business has been very well positioned by its management team to benefit from the recovery that we are inevitably seeing and going to see in Asia, and particularly in Southeast Asia. And finally, one of our investments, which is in the clean energy space, which is clearly a very, very topical sector. The whole world is focused on renewables at the moment when they're not talking about pandemics. And Maze Energy is one of our investments, which is one of China's largest manufacturers of blades for wind turbines. So if any of you know, some of these wind turbine blades can be almost 100 feet or even more long. These are no mean feats of engineering to build, but our business, Maze Energy, is one of the largest producers of wind turbines for both the onshore as well as offshore wind turbine industry. And China is one of the world's leaders in the development of particularly offshore wind turbine farms, as well as generating electricity from offshore wind turbines. So this business, Maze Energy, has done particularly well in 2020 and in the first half of 2021. Their factories have been almost running at full capacity. They have good order books from customers for their products, and we're very pleased with the way the business has performed, particularly in the first half of 2021. I think more generally as a company, we are continuing to see the effects of the pandemic paradoxically provide more of an opportunity for us as we go forward. There was something like a $2.5 trillion funding gap in the SME space in Asia. The latest estimates put that at around $3 trillion, and that's fundamentally because funding of SMEs and the sector has dried up during the pandemic. As you would appreciate, banks have become more conservative, investors have become more cautious. And as a result of that, the SME sector in Asia continues to be starved of capital. And that creates an even greater opportunity for Jade Road, because that is the space in which we operate in. Our approach to investing has always been to look for collateral and downside protection in how we invest in these underlying companies. As we've said, the market is massive. There's over 270 million Asian SMEs. They represent 98% of all companies in Asia, and they account for about 42% of Asia's GDP generation. So this is a significant part of the Asian economy, which has, as I said, been starved of capital, particularly so in the last 18 months. And we are seeing several opportunities present themselves in our pipeline. The reason Jade Road has not announced any investments recently is because I go back to our risk management and our focus on due diligence. And due to travel restrictions and other things, we've been very careful and very cautious about assessing opportunities, but not making investments until we're in a position to comfortably assess those opportunities on a face-to-face basis, which always includes due diligence visits, meeting management, etc. But as restrictions start to lift, my expectation is we will start to process some of those investment opportunities in our pipeline more rigorously in the near future. We're a sector agnostic investment company, and that is one of the major benefits of investing in Jade Road, that you're getting exposure to more than one sector. We're not focused particularly on any part of the Asian economy. We're very opportunistic. That being said, as our deck outlines here, there's a number of industries that we find attractive for obvious reasons, I would think. But the reality is that it enables us to look anywhere in Asia at any sector for the right kind of risk reward opportunity. And that is a significant advantage that I believe Jade Road has when we're assessing our current pipeline as well as opportunities to come in the future as a part of the recovery from COVID. Our portfolio at a glance, I've talked through most of them. And for those of you that are familiar with Jade Road, you will know that these are the companies that have been in our portfolio for some time. But these are again outlined in more detail in our annual report, in our interim results, and on our website. So I won't spend too much time speaking about these, as I've just given a quick update on their performance in the first half of 2021. And this is simply a graphical representation of the breakdown of our portfolio as at the 30th of June, 2021. Finally, I mentioned earlier on in this presentation that we have a non-executive board or an independent board. It's comprised of the individuals you see on the slide at the moment, led by John Croft, our executive chairman. John is a very experienced director with a lot of experience, both with AIM companies, AIM-listed companies, as well as other businesses, as well as having a lot of exposure to the UK, the Middle East, as well as Asia in his career. He has been affiliated with this entity for several years and is very knowledgeable about the portfolio as well as the inner workings of the business, and therefore is a crucial part of our business, particularly as the executive chairman. The other gentlemen on the screen have their relative advantages, given they are based in both Europe as well as Asia. So, for example, and in the Middle East, I should say. I apologize. So we have Viscount Hugh Trenchard, who's based in the UK. We have Stuart Crocker, who's based in the Middle East, particularly in the United Arab Emirates in Dubai. We have Dr. George Lam, who's based in Hong Kong, very well connected and very plugged into the Hong Kong corporate banking and regulatory environments. And we have John Batchelor, who is based between Hong Kong and Australia, but also is a representative or appointee of our major shareholder. So the board is extremely balanced, very seasoned, and very knowledgeable, particularly about Asia, but also about matters of corporate governance and running a company that is listed, which brings its own unique challenges at times. So that's a very brief introduction to the board. And I believe with that, I have come to the end of my section of the presentation. I'm happy to hand over to
Fantastic. Suresh, thank you so much for your presentation. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while Suresh takes a few moments to review those investor questions submitted already, I'd like to remind you the recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard on the Investor Meet Company platform. I'd also like to remind you that your feedback is important to the company, and immediately after the presentation has ended, you'll be redirected for the opportunity to provide feedback in order that the company can better understand your views and expectations. Suresh, perhaps before we move on to some of the questions that have come in during the event, we did have several pre-submitted questions. If I may, I'll just read the first one out, please. Harmony have done a good job with the legacy portfolio, but I looked at the website and there's no public record of Harmony's performance. Could you give some idea of your previous success, and if not, an idea of the returns that you're seeking on the non-legacy portfolio on an annualized basis, and what time horizon you're expecting to make new investments?
Yes, I'm happy to answer that question. So first and foremost, I would say that the reason there isn't any public information available on Harmony is because Harmony Capital managed private funds prior to taking on the role as investment manager of Jade Road. And as is very common in the private equity industry and in the private funds management industry, those track records are not a matter of public record because they're subject to usually non-disclosure agreements being signed, etc., for anyone who wants to see them. I would say that the Nomad, who oversees Jade Road at the time of our appointment, did fully vet our track record, because we did have to submit that to the Nomad when we were originally appointed as the investment manager. And so that is something that hopefully gives investors some comfort. Speaking to the actual level of returns we've generated in the past in some of our private funds, which, by the way, were managed across the global financial crisis, for those of you listening who may remember that particularly delightful time in our recent history. Overall, our returns were in the double digits, I can say that with some confidence for the portfolios we manage. And those were, again, very similar portfolios to Jade Road in that we were managing private investments, particularly in the SME space, focused only on Asia. And so in a sense, Jade Road is somewhat of a similar vehicle, very similar to the vehicles we've managed before. The only difference being that Jade Road is in the public domain because it's listed, as opposed to the funds that we managed in the past, and the track record that we brought to bear. I think the second part of the question, if I'm not mistaken, is how do we look at the legacy portfolio? What kind of returns are we targeting? I think our general approach to returns is that we're looking for either double digit, or when I say double digit, I'm talking about mid-teens or higher returns for any new investment we're making. I think it will be unrealistic to necessarily expect higher returns from our legacy portfolio when we exit it. So our targets, our target for exits are in that range, let's say in the mid-teens type of returns for our overall portfolio. I don't want to and can't say more than that because we would be weakening our negotiating position were we to be discussing an exit with a particular buyer. If I'm on record giving an exact number as to what I'm willing to recommend selling an asset for, or what kind of return we're looking for in particular, that wouldn't be very helpful to Jade Road's interests or the shareholders' interests, particularly if there are shareholders on this call. But I think by and large we're looking for sort of minimum of sort of mid-teen returns on our legacy portfolio when all is done. I'm just wondering if there's any other part of the question I may have missed out. I think I covered everything.
That was absolutely correct. The second one we had here, Suresh, is when you exit legacy or other holdings, are there any local taxes payable? And if so, have you taken these into account prior to calculating their carrying values?
So let me answer that question in two ways because it's a complex question. Firstly, at the local level, yes, there are taxes that apply, typically sales taxes, VATs, etc., particularly when in relation to our investment in future metal holdings. Those have all been accounted for in that the projections that were used by the independent valuer, and I must stress this, that SRK, the independent firm, independent of Harmony, independent of Jade Road, has now on several occasions provided an independent valuation. Taxes and so on are taken into account in their valuation methodology, which is obviously the standard practice from any credible valuer. But I would also point out that, and this is a matter of public record, again, it's in our interim results, I believe, but it's certainly in our annual report, that Harmony Capital recommends a further discount to any independent valuation on assets like future metal holdings, thereby, I would say, giving us an even greater margin for error should any of those assumptions being used by the independent valuer prove to be inaccurate at the time that we end up looking to exit an asset. So that's the first way in which I would answer that from the question that's been posed. But secondly, and it's very common to own assets, particularly in Asia, as we do, through SPVs, which sit in tax, shall we say, tax-friendly jurisdictions due to our tax planning. And Jade Road itself is in a tax-friendly jurisdiction. It's a BVI incorporated vehicle, even though it's quoted and traded on AIM. So the incidence of tax, were we to sell the asset offshore, in other words, if we were to sell an SPV rather than the underlying physical asset, which is actually quite common, is to sell the offshore vehicle itself. In theory, and actually in practice, because we have plenty of experience with this, the incidence of tax is almost negligible.
Fantastic. That concludes the pre-submitted questions, Suresh. If I may just ask you to click on that Q&A tab and just, where appropriate to do so, if you could read out the question and give your response, that'd be wonderful. Thank you.
Sure. I'm happy to answer all the questions. I try not to shy away from answering anything because
thank you so much.
I'm more than happy to take on all these questions. So the first question, well, it's a series of questions from one user, one attendee. I'm sorry. Thank you for that. First question is, what is the competition for capital like for the Asian IPO, pre-IPO deals? I believe this is referring to the fact that Jade Road made an announcement recently that it will start considering investing in potential pre-IPO opportunities, so companies that are very near to IPO or to an initial public offer. The competition for capital in that space is quite dramatic because there's been so much capital looking for a home over the last, let's say, 18 months, that there are a lot of funds that can invest in those kind of companies that are near to being public, that they're looking for a home, that capital is looking for a home. So we find that actually some of the pre-IPO transactions we're currently assessing in our pipeline for Jade Road, there is a lot of capital looking to invest, and oftentimes these IPOs are oversubscribed, well oversubscribed. Now, it's a very different story when you're looking at the SME space, where we operate as our bread and butter, as I mentioned earlier, because there's a dearth of capital, there's a massive funding gap. So there's very little capital available to SMEs who are looking for growth capital, who are not ready to IPO maybe for several years, and they're looking for that private capital. But in the pre-IPO space, the competition is fairly robust, and I believe that's because there's been a shortage of both IPOs and IPO opportunities for a lot of investors to put their money into over the course of the last 18 months. Second question is, with concerns over the forecast for China's economic growth, how much of your current portfolio pipeline is China-based? Or is it more interesting to ask the question for future investments potentially, what is your risk appetite like for mainland Chinese companies right now? Okay, so our exposure to China is a matter of public record. We have over 50% of our portfolio, which is entirely legacy portfolio driven exposure to China. There's nothing we can do about that other than to reduce it. And we are on record as saying that we will look to reduce our exposure to China and that we're actively looking to potentially divest our legacy assets. We've said that, I've said that publicly, and I stand by that, as does the board. So we are certainly looking to reduce our exposure to China, and that was the case well before the recent, shall we say, uncertainties and the recent sort of concerns over China cropped up. And by recent, I mean even as recent as the last 2 or 3 weeks with the crisis around Evergrande, the property developer. But our economic growth model for China is one that we believe, at least in the short term, that China is not going to be as severely affected as one may read in the press by, for example, the default of Evergrande. Things like property developers and so on, while they make for good news and for good viewing, the reality is that they are very small parts of the Chinese economy as companies. I'm talking about as companies. I would be hard pushed to name a company I could think of in China that would be considered genuinely too big to fail. And so our view is that over the short to medium term, Chinese growth will continue, will remain. And in a sense, our assets are entirely are not dependent, particularly on the property sector, first and foremost, if there are any concerns over property. And we believe that our intention to divest those assets are unfettered by what is going on at the moment. That being said, the reality is investors will be more cautious. Of course, people will be more cautious about looking at assets or buying assets in China, the ones we're looking potentially to sell. So that may elongate our exit process somewhat. I'm not sure, but it could. But overall, our thesis hasn't changed, that these assets are in an attractive position and that we can divest them in due course. I think the other part of the question is more interesting. And that is, what is our view essentially, and what is our risk appetite for mainland China and Chinese companies right now? In a sense, it is non-existent. Our risk appetite is non-existent because, as I just said, we're looking to divest our positions in China and reduce our exposure to China. That being said, I want to be very clear that we are a pan-Asian business. We're a pan-Asian portfolio. No one can be credibly pan-Asian without having some exposure to China. China is one day will be the largest economy in the world. It's certainly Asia's largest economy, and it is a very, very important part of the Asian economic landscape. And we believe that China is a market where one should have exposure and have investments. Right now, we think our exposure to China is something that can be reduced because, as I said, it's a legacy of what this business used to do, which was be very China focused before Harmony Capital came along, and now we're looking to reduce that. So I hope that's addressed some of the questions, some of them, I guess, the point of those two questions. So thank you for submitting those. The next question is, what's the strategy to demonstrate you will be able to close the gap between NAV and share price? What should we look for? That's an excellent question. It's one that I ask myself on a daily basis, if I'm not being overly facetious. We have had a discount to our net asset value, all jokes aside, for, well, as long as Harmony has been in the saddle, so to speak. Our board, myself, our executive chairman, and I speak daily. This is the fundamental issue that we are trying to solve for. Our view is that given all of the initiatives we've taken, and there are several of them, if you go back and look at our announcements, if you look at even our chairman's report in the interim statement, There's a commentary there of all the things that we are doing as a company. However, I think perhaps the thing to look out for is exits, particularly from our legacy portfolio. I think that's one question that perhaps investors, and again, I'm speculating, well, somewhat speculating, is that the question perhaps that overhangs most investors' considerations are, well, there's a net asset value, there's a share price, there's a significant discount, which I believe, Harmony believes, our directors believe, because we've all invested money on this basis. We think it's a huge opportunity given that massive discount. But at the same time, narrowing that discount, I think, will be assisted by us being able to exit some of our legacy portfolio to further substantiate the claims that we're making, that these assets are worth what they're worth. So being very honest about it, I think that's something that we could do better, and we are, as I said, focused on doing, and something that investors should look out for. On the other hand, if you wait for that to happen, there may not be a discount to net asset value for much longer, or at least an attractive one, because then the horse is bolted from the stable. So it's a timing game, I think, if investors are looking to take advantage of our discount. Another question, thank you for that question. The other question that's been submitted is, how much of your time is devoted to Jade Road? Presumably as managing partner of Harmony Capital Investors, you have other commitments. I have other personal commitments, including to my family, but no, my time is dedicated to Jade Road. My team, Harmony Capital's team, is dedicated to Jade Road. We are not prohibited from managing other vehicles. We're not prohibited, as long as obviously they don't compete with Jade Road. But at the current time, and for the last few years, we have been only focused on managing Jade Road. And as I said, we deal with it on a daily basis, and are privileged to do so for the benefit of our shareholders. So thank you for that question. And then another question is, I understand that the major quoted China wind turbine companies valued on a rating of 50% of their international competitors. Given that, would you expect to divest your interest internationally rather than locally? Is that interest valued on a local peer group basis? I can answer the last part of that question first. Yes, it's valued on a local peer group basis. It is essentially valued as a domestic company, because as you would appreciate, shipping a 100-foot turbine blade across the globe is not feasible. So these are very domestic businesses, which is why they have 3 factories. They all operate in areas where there are large wind assets, wind resources, which by definition means there's a number of wind turbine clients in those areas, so they can easily transport their products. So they're run as a domestic business. That being said, would this company be of interest to an international business, or for, let's say, strategic investors out of a region like the Middle East, as an example, where there's a huge push to diversify investments and investment focus away from property and traditional fossil fuel energies to clean energy and to renewable energies? The answer is yes, it could be of interest. So in terms of our divestment strategy, again, without saying too much that would weaken our negotiating position as a shareholder, what I could tell you is that I think Maze Energy is in a very strong position currently, just given that it's performing very well. It's in a hot sector. It's in a country where people are beginning to increasingly take renewable energy, and wind energy in particular, very seriously. And I would imagine that would potentially attract a fairly large audience of interested parties when the divestment process begins.
Suresh, thank you so much. You've answered every question we've had that come through from the investors here. And if there are any further questions, of course, you will have the ability to review those, and we'll publish responses where appropriate to do so on the Investor Meet Company platform. So if I may, could I ask you just for a closing snapshot of Jade Road, and then we can redirect the attendees to give you some feedback.
I'd be happy to do that. So as I've said in my opening comments, Jade Road is somewhat of a unique vehicle. It is the only London-listed investment company that I'm aware of that focuses on the Asian SME space, the small and medium enterprise space. Those companies operating in that small and medium enterprise space in Asia, which number approximately 270 million entities, are starved of capital. They have almost $3 trillion US dollars worth of demand for capital. This is objectively and empirically identified by the World Bank and the IFC, not by Harmony Capital. And yet there's a dearth of capital feeding those companies in that segment. So our vehicle is set up to fund companies in that space. We find it very easy to operate with almost little to no competition. And given that that is something that has become exasperated because of COVID, because of the pandemic, and because of the slowdown in deployment of capital as a result of the slowdown in economic activity in 2020, we see a huge opportunity ahead of us for this vehicle as Asia continues its recovery from the pandemic. And for those investors looking at us at the moment, as I alluded to earlier, we're trading at a significant discount to our net asset value, and I think it warrants a very close look.
That's fantastic. Suresh, thank you indeed for updating investors today. Could I please ask investors not to close the session, as you'll be automatically redirected for the opportunity to provide your feedback in order that the management can better understand your views and expectations. This will only take a few minutes to complete and is greatly valued by the company. On behalf of Suresh and Jade Road Investments Limited, I'd like to thank you for attending today's presentation. That concludes today's session, and good afternoon.